Alright guys, welcome. In this module, I'm going to explain to you what internal and external range liquidity is. Alright, and I'm going to show you apply it live on the chart. So this is going to be a very important lesson, and I believe that you're going to learn a lot of stuff. It's going to basically be a very nice overview or summary. We're going to factor in so many concepts that we've learned so far inside this course. So please take this lesson very seriously. So first of all, internal and external range liquidity are ICT concepts used to describe where liquidity resides within and outside a defined range. Understanding the relationship between these two liquidity types helps traders anticipate how price is likely to move through a dealing range. So if we just look at the graph here, we see the higher time frame range, all right, and then we see a couple of moves within that range. Okay, we do see a market structure shift at the top here, and then we see price basically retesting that area, and then what it does here, it fakes a move to the downside and then engineers buy side liquidity. What it does, it prints this top here. So you can imagine that funds as well as retailers are going to put their stop losses or their buy stops just above this high over here. What it then does, it just runs these buy stops aggressively. What the algorithm does here, the marketplace is basically building their sell positions by pairing them with the buy stops, by pairing them with the counterparties who are basically buying here. Buying by way of either closing their sell positions or activating buy stops. That's why this high is being run and it's being liquidated. And then from there, what we're seeing is once this liquidity pool is being run through, we see a dynamic, aggressive response from there. Because this is a sub-range, right, under this whole range, that is what we call internal range liquidity. So even if institutions want to move price lower, if they want to see price surge lower aggressively up until this external range, up until this low, they're not just going to print down candles. While price is actually decreasing and coming lower, they're going to grab internal range liquidity. They're going to engineer new liquidity pools and sweep them in order to rebalance price. So here on this chart, we see exactly what we mean by external and internal range liquidity. Okay, we see this move, we see price running lower, and we have a range, an external higher time frame range, but within that range, we're constantly seeing internal range liquidity. We're seeing new order blocks being printed, we're seeing new fair value gaps, imbalances being created. Okay, what price does, it retraces and rebalances those imbalances. So price is basically being drawn into these imbalances to rebalance price and make it efficient. Okay, once it does that, once it actually finds its bottom, what we see from there is we see an order block. So this black candle is an order block. That is being confirmed by the next candle, which closes above this candle. So that confirms that this black candle is now our order block. And then we're seeing price run through that, break above it, and then we see price pierce into that order block. It just touches the order block, and then we see a dynamic response from there. Okay, so this is exactly what happens in basically any marketplace and any time frame. So let's just imagine that this is a higher time frame. Okay, this could be a weekly chart, it could be a monthly chart, or it could be a daily chart. What we see here is clearly we see an uptrend. We see a higher high, higher low, and then we see another higher high. We see a correction back into the discount zone, and then we see a reaction from there. What you're going to see, rarely you're going to see just a aggressive retracement like that. In most cases, what the interbank price delivery is going to do, they're going to engineer new internal ranges and internal range liquidities they're going to engineer and print relatively equal highs that are being swept in order to trap retail traders. That's what they're going to do. What we see here is we see an order block being printed. This is the higher time frame order block. And then what we see here is a fair value gap or an imbalance. Okay. And then we know that once this high is being created, that is our external range liquidity. So we have tons of buy stops sitting above that high. Okay. What the institutions are going to do, what they want to do, they want to buy price low, and then they want to sell price to those buy stops over there. Just because now they have their counterparty who are willing to buy, like breakout traders, for instance, and then they can just sell their buy positions to them and take profits. That is why this is our external range liquidity. Price is going to be drawn towards that external range liquidity. But while doing that, before price actually comes down to this discount zone, we're going to see tons of fair value gaps being created. So we could have a fair value gap here. We could have one here, for instance. What else could we have? So this could be another, order block. And then from there, we could see a dynamic response, a dynamic reaction from there. But the most important information here is that basically what this does is it takes out internal highs and lows, it sweeps them, and then gives the next move to the downside. All right. I hear you asking, how are we going to know if any high is going to be taken? Now, you got to be a bit patient because we're going to get there within this course. But for now, I just wanted to understand what the difference is between external and internal range liquidity. So what we see here is we tapped into the order block and then we saw a break of structure, a market structure shift. So possibly we had an order block here, and then we see price retesting that order block, rebalancing price, and then giving us a reaction from there. That is going to be our internal range liquidity. Now the external range liquidity in the higher time frame is going to give us a target, an objective. The internal range liquidity is going to give us context for our lower time frame entries. So we want to position our trades, our positions at these areas, and then what we want to do is we want to target the next internal range liquidity, which might be the next high. It could be the next high over here. Okay, this could be our next target. And then eventually we want to target the external range liquidity based on the higher time frame. Now let me just give you an example of how this looks like in live in the marketplace. Now, so this is the monthly chart AUD/USD. Okay, what we see here is we see an impulse. This is distribution or displacement. And the very last candle here, that is an order block. This is a monthly order block. So if price comes here, we should see a reaction from there. And for that, we go down to the lower time frames in order to see if price actually wants to give us the reaction. But eventually what we see is price basically runs through and breaks above this order block. So this order block is being invalidated and has become a breaker block because it has been broken. What we see then is we see price retesting it and rebalancing and then printing us a next order block. So this black candle here is our new order block. Why? Because it's been confirmed and validated by the next candle that closes above it. All right. So we should see price coming back into, tapping into the order block and then giving us a reaction and possibly target and run out the buy stops above this high. That is what we should see. Now, this order block over here is too large because it's almost 50% of this range over here. So we can't just enter a position like this. We can't just go put a buy position here, because we're going to wait like entire months for this trade to play out. In order to position our entries, what we're going to do is we're going to actually get into the lower time frames in order to have more insights into this price action here. So what we want to see is we want to see the weekly order block that printed these candles. From there, we might want to go into the daily and see if we have more context and more details that we can base our execution upon. Okay, so let's just call this, all right, let's just call this a breaker. And then what we also see is, so what we do is we take the order block over here, we take the body of the order block, and then we see how price actually reacted from there. And as we can see, it just touched the mean threshold, the 0.5 level of this order block, which has now become a breaker. But then, do you see how dynamic this response is? It basically shows us, it's basically revealing, it's tipping its hands. Okay, the market, the institutions show us where price wants to go, where they want to move price next. We see a dynamic response from here. We see that this breaker block is being respected, so that now we can look for long setups. So we're still in the monthly time frame, but we're going to get into the low time frames to actually see more price action. So let's just go down to the weekly charts. Now we have more context. All right. So this over here was our monthly breaker block. This is the monthly breaker block. In the weekly charts, what we see is very simple. We have a range that has been printed. So this is our range. Okay. This black candle is now our weekly order block. This is the weekly order block, and it's being validated by this candle over here, closing above the black candle. So what this will do is this will now function as a support zone, as a support level. So what we see here is price tapped into this breaker block and then ran out this high over here. So this high has been taken and has been broken at the same time. Okay, so the buy stops have been activated here, right? Prices, what we see here is this institutional displacement. All these candles over here show us, okay, institutional sponsorship. We see that the institutions wanted to move price higher, because an increase in price like that is not something that happens at random. Okay, it's being institutionally engineered. All right. Let's go even further down to the daily time frame. What we see here is even more beautiful. Okay, what we see here is we see relatively equal lows being printed here. So these are relatively equal lows, if you see, all right, and that has been liquidated, all right, and from there we see this huge displacement over here, this huge displacement. Now we're going to look for the order block that has generated this move, this main impulse, this displacement, this price delivery. And if we pay attention, these two candles over here, the very last down candles, all right, before this displacement was being generated, were these two candles. Now, these two candles together are going to be my daily order block. So we can just specify even more. If you remember, our weekly order block was huge, okay? So the weekly order block was here, all right? So this is almost 50% of this whole range. So that's not going to help us in actually positioning ourselves and executing our trades, because it's just because there's no content, because there is context, but there is just no precision. We want to position ourselves precisely, which is why we go down to the daily time frame, okay? And then we have more context and more details, and we can actually specify our zones, and our target levels as well. So we see a dynamic response. What we're doing is basically, once these highs are being ran through, what we see here is a market structure shift. All right. So this is a high, this is a swing low, then we have a new swing high, and then we see that this swing low is being disrespected, is being invalidated. We see a break of structure, and then we see a retracement back into this fair value gap over here. So this has now become an internal range. Okay, so this is the overall external range. That is the external range. The external range liquidity is going to sit above these highs over here, because we can also see how these relatively equal highs were being printed and engineered by smart money. It's just too clean. That tells us that these highs are probably going to be taken sometimes in the future, at some time in the future. So we're expecting a correction now and a rebalancing of price into this order block, or at least into the discount level of this higher time frame weekly range. What we want to see is a 2-step or a 3-step correction back into the discount zone, because what we want to do is we want to capitalize on the next move that is being generated by smart money. Smart money is going to move price lower in order to build their next buy positions. So what we're seeing here is we're seeing a market structure shift, and we're seeing price coming back into this fair value gap. So let's just highlight that. But then at the same time, price actually retested this mitigation block. So this very last candle here, actually this entire move, all right, so this entire move is going to be our mitigation block, all right. But then the very last candle before that move was being printed, that is our mitigation block. Let's just highlight that. What we're seeing is price actually tapping into both the fair value gap and also this mitigation block candle. All right. We're seeing price actually tapping into the mean threshold of the fair value gap, and also into the 0.5 mean threshold of this mitigation block over here. So I'm gonna change the color. Let's just change it to blue, all right? And then this fair value gap, we can change it to red. So we see that this fair value gap has been respected. Price has been rebalanced. It has taken, price is seeking internal range liquidity by taking out these highs in order to then give us our next move to the downside. And then once this internal range liquidity is being taken, it's going to target the next external range liquidity in the lower time frame. Now this is very important, guys. I told you that the external range liquidity in the higher time frame, which was the weekly chart, we're sitting here. That was our external range liquidity, and then just below this low over here. If we're in an uptrend, then this external range liquidity over here is going to be high resistance. Okay, so price is going to be unwilling to attack that external range liquidity because our trend is just bullish. But what it's going to do, it's going to seek our external range liquidity in the higher time frame. But before doing that, it's going to print internal ranges in the lower time frame. So this is going to be our internal range. Once that's broken, this is now going to be our internal range in the daily time frame, in the lower time frame. So once we have this dynamic response from there, what we're seeing here is, because the trend in the daily chart has now become bearish, we're seeing that this low over here has become a low resistance liquidity pool. It has become low resistance liquidity. Okay. So we're going to see these order blocks being disrespected because price wants to move lower. What are we seeing then here? What we are seeing here is price actually comes back into the new fair value gap in the daily chart. It taps into the wick of the order block, and then it gives us the next move. All right. So the next low over here is going to be low resistance liquidity. Once we're actually getting into the next move in the higher time frame, now this order block over here is going to be low resistance because price wants to go higher now. So this is probably going to be broken, and we can expect price to attack and target the external range liquidity in the higher time frame. Okay, so what that basically means is the following. So price is going to be drawn to the internal range liquidity in the lower time frame, to the external range liquidity in the lower time frame, and then while doing that, it is going to be drawn to the internal range liquidity of the higher time frame. Okay, so price is basically rebalancing itself, and then it's going to attack the external range liquidity in the higher time frame. That is going to be how the cycle is going to look like. Okay, so once we arrive at this order block here, we see the exact same thing. If we just pay attention, we see an order block being created here. So these two black candles over here, that is going to be our order block. I'm just going to highlight that for future purposes. So we're going to get into the 4-hour time and the hourly time frame to actually see price action in more context. So the higher time frame context is on the weekly and daily charts. On the monthly chart, we have retested the breaker block. On the weekly chart and the daily chart, smart money printed this new range, and then price arrived at a discount zone based on the daily chart. It's also at this very important institutional level, which is the daily order block. Okay, so what we want to see here is now we want to see a dynamic response from there. We don't just want to enter into positions. We want to catch the move, yes, but we want to analyze price action in the lower time frames to execute. That is very important. So what we see here is we see black candles over here, two bearish candles being validated by this bullish candle because it closed above both of these candles, which to us signifies that this is now our order block. What we see then is price basically retests the order block and then closes above. So once price closes above, if you pay attention, this new bearish order block, this is our new bearish order block. Because why? Because the next candle closed above this candle. So these two, we just forget about these two candles now because this black bearish candle has now become our new order block. We also call it propulsion block. Propulsion because it propels price to react from there. And then what do we see? Let's just update this order block. So I'm putting this line over the new propulsion block, which is our new order block. We see price piercing into the order block and then giving us a clean reaction from there. Okay, so this new candle validates this candle as our new order block. So price shouldn't break that level. What do we see? So this is going to be our next order block. Let me just draw that. We see price just touching that and then giving us displacement and a nice reaction from there. Let's just analyze this in the lower time frames in order to see how price moves. So this is the 4-hour chart. And now we can see this whole price action in more detail. So what we see here is the following. We see tons of order blocks being printed. We see these 4 candles over here. These were the very last candles before we had our first market structure shift. So we can just highlight these as our 4-hour order block. And then we see price coming into it. And then we see a dynamic response from there. Okay. See a beautiful response from there. So these three candles that closed above these bearish candles, now they validate now that these has become our next order block, which we also highlighted in the daily chart. So in the daily chart, we highlighted this as the daily order block, the propulsion block. We see beautifully how, like handsomely, how price actually comes back into this order block, and then we see a beautiful reaction from there. And we also see how price actually was seeking, how price actually grabbed the internal range liquidity, which was here, the swing low. We see liquidity sweep, and then from there we see how beautifully price has reacted from there. So this now has become our 4-hour range. Let's just highlight that. And then I'm going to use just white. So this is going to be our 4-hour range. All right. So I want you to understand this, guys. I want you to actually pay attention to where this price action is actually located in the higher time frame context. So let's just go back to the daily chart. Okay. So we're seeing that in the daily chart, this whole price action is still in the discount zone. So if we just look at this whole daily range, we can see that this price action over here is still at the bottom 50% of this whole range. So we're still at the discount zone. So our first target is going to be this high over here. That's going to be lower resistance, internal range liquidity in the daily chart. That is going to be internal range liquidity in the daily chart. It's going to be low resistance because why? Because what we're expecting now is these highs to be, because we're assuming that the whole wave has now changed and price is basically going up to the contrary direction. So we're expecting these highs to be taken. So that's going to be our first higher time frame target. This fair value gap over here is going to be our second target. And then eventually we're going to target the external range liquidity based on the daily chart, because we want to see price go up there. Because why? Our context, our narrative, our daily narrative is we're in an uptrend, and this is in the daily chart. This is going to be external low resistance, external range liquidity based on the daily charts, based on the daily time frame, and smart money is going to move price up there. This doesn't mean that we're going to just see one displacement. No, it is still, whilst doing that, it is going to create internal ranges like this. It's going to seek those internal range liquidities, and then it will give us the next move and the next move and the next move. Okay? All right. So this whole price action here, which was based on the 1 hour time frame that we highlighted here and delineated, right? Delineated, is still at the discount zone based on the daily chart. So let's just go back to the 1 hour time, to the 4 hour time frame to actually see what's happening there. What's exactly happening there. So we're now in the 4 hour time frame. I want to show you guys the price action in the 1 hour time frame. Okay. So this is the 4 hour time frame. So this is basically textbook smart money, guys. This is textbook smart money. So this is our order block. So this here is our order block based on the 4 hour time frame. So once we have this new impulse, we should see some sort of retracement, and whilst price is doing that, it should seek internal range liquidities like it does here, and then like it does here, it's going to retrace, rebalance price, and then it's going to target, it's going to attack the external range liquidity based on the 4 hour time frame. Because why? Because in the context of the higher time frame, we're expecting price to go higher and then attack the internal range liquidities based on the higher daily chart, the higher time frame. Okay, so this was our first target, our first internal range liquidity within our daily chart. So that internal range liquidity based on the higher time frame is going to sit above the external range liquidity based on the hourly chart. So this is, I hope this doesn't confuse you guys, but let's just go back to this over here. We said price is going to seek internal range liquidity based on the lower time frame. So this is an internal range liquidity based on the lower time frame in order to attack the external range liquidity in the lower time frame, to attack the internal range liquidity based on the higher time frame, which was this swing high over here that we highlighted in the daily chart. Okay, so based on the daily chart, this swing high, this fair value gap, and then eventually the external range liquidity based on the higher time frame, which was the daily chart, that is going to be our main objective, our main target. So again, if we just pay attention to the 4-hour time frame, this is exactly what we're seeing over here. We see a main impulse, we see displacement that shows to us institutional sponsorship. Let's actually go down to the 1-hour time frame because I believe that this is going to be very interesting, guys. So in the 1-hour time frame now, we have actually more context. Okay, we have tons and tons of more detail and context. We see that this move over here generated this main impulse. But what we can do, actually, we can highlight these very last down candles in order to signify, in order to highlight, in order to delineate our hourly 1-hour order block. So this is our 1-hour order block. Do you guys see this whole idea behind a top-down analysis, guys? I hope you guys see it. We started from the monthly chart. We drew the breaker block. Then we drew the order block based on the weekly chart. Let's just go back to the higher time frames. Okay. So this was the block based on the monthly chart that was broken. And then we saw on the weekly chart that this candle, okay, pierced into this breaker block, which to us signified that now price wants to go higher. Then in the daily chart, we actually specified in detail how this weekly order block looks in the daily chart. We actually got into depth into the lower time frame, which is the daily time frame, but it's relatively low compared to the weekly time frame. We've highlighted the order block. Then we saw a dynamic response from there. What we're now trying to do is position ourselves within this daily move. All right, so we're basically just, this is the whole higher time frame move. This is the big wave, but we want to surf the smaller waves within that main wave. That's what we're trying to do. What we're trying to do is we're trying to identify the external range, and then within that external range, we're going to have lower time frame internal ranges, but we're going to see those internal ranges in more detail in the lower time frames. Okay, guys? So this is why they call it ICT matrix. It's basically like a matrix because you have to go down from the higher time frame to the lower time frame in order to understand the different layers. You need to acquire a layered understanding of price action because price is fractal. It's going to do the same thing in the lower time frame what it does in the higher time frames. Remember how we said that the monthly order block was being broken, and then we considered that to be a breaker block, and then it created an order block? That's exactly what it does here. So we're seeing candles being broken and retested, which makes them, those candles, order blocks. What we're looking for first is a market structure shift, a break of structure, which is basically what confirms to us that these down candles are now being order blocks. So let's just go back to the 1 hour time frame. So this is basically what we're seeing here. What we're seeing here is the 1 hour time frame being touched. So this would be a perfectly reasonable trade, guys. We could position ourselves here. We could put our stop loss just below this 1 hour order block. and then we could target the external range liquidity based on the 1 hour chart. And if we're patient, what we can do is we can actually target the higher time frame objectives, which is the internal range liquidity based on the daily chart. Okay, we could do that as well. What we want to do once we're in this trade, we want to set several targets. We could take this as our first target, and then we could take the external range liquidity as our second target, and then we could take that as our main objective, our last target, and then we could just take partials along the way. That way, we're going to make sure that we're actually making profits, because anything could happen anytime. Okay, we want to close profits, and we want to close partials and take profits along the way, so that we don't run the risk of being profitable deeply and then being stopped out, because it could happen anytime. Okay, good. So this could be a perfectly reasonable trade, guys. We were seeing that the 1 hour time frame created this range, but while giving us the correction, what we're seeing here is price actually attacked the internal range liquidity like it did here. So what do we see here? We see a fair value gap being printed. All right, this is the fair value gap. Price touches that, rebalances itself, and then we see the next move. And then we see price actually taking out these relatively equal lows over here. So that is going to be internal range liquidity based on the 1 hour time frame. And here, the exact same way, we could actually target these lows as our first target, and then we could target the daily order block as our second target. We don't want to target the external range liquidity based on the 1 hour time frame, because why? Because we're expecting price to actually move higher and higher. Okay, all we want to do is position ourselves within this retracement, but this is going to be a high risk trade. Because why? Because the monthly chart is bullish, the weekly, the daily chart, they're all bullish. The 4 hour time frame is bullish. So why would we risk going into this trade just because we call a beautiful market structure shift and internal range liquidity and a fair value gap? Why would we do that? Because the higher time frames, because we're not in sync with our higher time frame analyses. Beautiful. What do we see after that? We see in the 4 hour time frame that we saw a dynamic, beautiful, handsome response from this area of interest. This huge candle over here validated to us that this now has become our new order block. Okay, we see price coming back into it and then giving us displacement. All right, and then we're seeing this low, this swing low being engineered, and then it's being taken out. Once this swing low is being printed, it's being taken out. So this is internal range liquidity, and then this now is our new order block based on the 4 hour time frame. Based on the 1 hour time frame, we actually see that this candle is being validated and confirmed to be our next order block, price coming back into it and then giving us another response to the upside. Okay, what do we see here? This was actually a trade that we took yesterday. So let's just go down to the 1 hour time frame. Okay, this is beautiful, guys. This is basically just the same thing happening. Okay, we're seeing this move, this main impulse over here. This is the next impulse, and this was our very last 1 hour order block. And accordingly, this is our new range. Let's just use our Fibonacci tool. So that's going to be our Fibonacci tool. We're highlighting our order block. We're seeing price coming back into the optimal trade entry, which is this whole area between the 0.62 to the 0.78, if not 88. That is going to be our optimal trade entry. Okay, we're seeing price coming back into the order block in the 1 hour time frame, and then we see displacement from there. Our next target is going to be our internal range liquidity sitting above these highs. I want these buy stops being taken, and then my second target is going to be these relatively equal highs, okay? And then I'm going to see price actually being drawn to our next higher time frame PD array, which is our higher time frame internal range liquidity. And we can actually go back to the daily chart in order to see what I mean. So this is the trade that we have positioned ourselves into. So this last high, I'm expecting that to be low resistance internal liquidity based on the daily charts. So I can use that as my next target, as my next objective based on the higher time frame, but it's going to be external range liquidity based on the 1 hour time frame. But I can reasonably expect price to go there to attack those highs based on the higher time frame, which was the daily chart. So I hope this helps, guys. This might be a bit confusing, but this is just to give you an idea of how powerful this strategy is and how detailed you have to approach the marketplace every single day, every single week. Why do we start with a monthly chart? Because once we have a monthly directional bias, what we can then expect for price to do is we can basically, once we have a monthly directional bias, we can expect price to continue that direction for the next 6 months, 9 months, 12 months until we've actually taken and ran through the next liquidity pools in the monthly time frame. That's very reasonable. Because why? Because we have the higher time frame monthly objective and target and context in mind, and we're in sync with that higher time frame objective. So once we have a higher time frame objective and directional bias, you can just reposition yourselves every single week, almost every day. If you just go back to the 1 hour time frame, let's just see how many trade setups we've had. Okay, so this was one trade, price coming back into this order block, and then from there we can attack these highs. We had this entry over here, which we can capitalize on based on the 1 hour time frame. This is, just look at this. We see the exact same pattern happen over and over again. We see another order block over here. We see that price comes into it. It just taps, it pierces it. It just taps into it and then gives us displacement. Then we see new order blocks being printed and engineered. Okay. And then we see new ranges being generated. Price coming back into the discount level within that internal range, within that lower time frame range. And then we can just enter our positions up, buy positions here. Once this is broken, okay, we can expect for another order block over here. Do you actually see that this almost looks like a harmonic pattern? Okay, but here's what I want you to understand. Just trading patterns by themselves is not going to make you profitable. Just trading patterns, just because you recognize a pattern somewhere without any context, is not going to make you profitable. It's going to hurt you, because that's eventually what retail traders do. What you always have in mind, you want to move in sync with the higher time frame directional bias. That's the most important lesson that you should take home with this lecture, with this module. Okay, I hope this helps, guys. I hope this helps to understand both of these concepts, internal and external range liquidity, and how price action actually goes from the internal into the external, from the lower time frame to the higher time frame. I don't want you guys to get trapped into the noise. I want you to be able to understand where we position ourselves and what makes sense the most, starting from the higher time frame, from the monthly time frame, going down to the weekly, the daily, the 4 hour, and then eventually the 1 hour time frame. Okay, guys, perfect. I hope this helps, and see you in the next module.